Today I will be discussing about the investment avenues like financial derivatives, life insurance avenues for investment under life insurance scheme, and I will be discussing about the physical assets, investment in physical assets like real assets, precious metals, precious stones, art objects and collections. To, to start with, I will be starting with financial derivatives. Hope you all know about financial derivatives. About derivatives, what is derivative? It is an instrument whose value is dependent on the value of some underlying asset. Hence, it may be viewed as a side bet on that particular asset. And from the point of investors and the portfolio managers, futures and options are the most important financial derivatives, and these derivatives are used for the purpose of hedging and speculation, and trading in these derivatives has also begun in India during 1990s and 2000. Actually, there are four types of derivatives, that is forward derivatives, future derivatives, options and swaps. Today, in order to give a brief introduction about derivatives in this subject, I will be discussing about futures and options. What are futures? So actually derivative itself, it is a contract. We call them as a contract. And future, it is a contract, or it is also termed as an agreement between two parties to exchange an asset for cash at a predetermined future date for a price that is specified today. And the party who agrees to purchase the asset is said to have a long position, and the party who agrees to sell the asset is said to have a short position. That is, the party whoever buys the asset on a future date, that is on the date of contract, is termed to assume the long position, and the party who has agreed to sell the asset is termed as or is assumed to have a short position. See, for example, the party who is holding the long position benefits if the price increases on the day of the contract, execution of the contract, whereas the party holding the short position loses if the price increases, and vice versa. For example, consider a future contract between two parties A and B. A agrees to buy 1,000 shares of ABC chemicals at rupees 100 from B to be delivered 90 days hence. That is, from today it is agreed to buy ABC chemicals 1,000 shares at rupees 100 per share from B, and that has to be delivered 90 days from today. And A is taking long position and B is taking short position. That is, A will buy the shares, 100 shares, and B will sell 100 shares at rupees 100 on the 90th day from today. A gains if rupees 5,000, that is, he gains rupees 5,000 if the price on the day is 105 rupees per share. He will be gaining rupees 5,000. That is, he has agreed to buy at 100 rupees, but on the day in the market it is sold at 105 rupees. Hence, he can exercise his right to buy the shares at rupees 100, hence he is going to gain 5,000 rupees. On the other hand, if the price of ABC chemicals on the 90th day from today happens to be 95, that is, if it is selling in the market at 95 rupees, A will lose 5 rupees. And that is 5 rupees per share, in the sense 5,000 rupees per share will be lost by A, and B will gain 5,000 rupees. Instead of selling at 95 rupees, he will be selling at the contract rate, that is rupees 100 per share, and hence for 1000 shares B will be gaining 5,000 rupees. So this is about future contract. So now what are options? An option gives its owner the right to buy or sell an underlying asset. That is, here my focus is on equity shares on or before a given date at a predetermined price. That is, the option will represent a special kind of financial contract under which the option holder will enjoy the right for which he pays a price, but he will not be having an obligation. That is, he will not be having any obligation to buy. Okay. And under options, there are two types: call option and put option. What is call option? Call option gives the option holder the right to buy a fixed number of shares of a certain stock at a given exercise price on or before the expiration date. And in order to enjoy this option, the option buyer will pay a premium to the option writer, that is the seller, which is not refundable. That is, here under call option, option buyer will be having the right to exercise the contract but not the obligation, and hence he will pay some premium at the time of entering into the contract. And if at all, if he is not exercising his right, that part of amount, the premium that has paid on the day of entering into the contract, will not be refundable by the seller. And the seller of the call option is obliged to sell the shares at a specified price if buyer chooses to exercise his right. That is what is called as call option. Now, what is put option? A put option gives the option holder the right to sell a fixed number of shares of a certain stock at a given time. That is, at a given exercise price on or before the date of expiration of the contract. And to enjoy this right, the option buyer, that is the holder of the option, has to pay a non-refundable payment to the option seller, that is the writer. And when the put option, that is the holder of the put option, exercises his right when the market price is lesser than the contract price, he will exercise his right, and hence put option is obliged to buy the shares at a specified price if the option holder chooses to exercise the option. So students, I hope this is clear to you. A small introduction about the derivatives. Okay, this is also one of the instruments in the derivatives market for the purpose of hedging. That is, in order to reduce the risk that either of the parties have assumed, they will enter into the contract. So next type of investment avenues is life insurance. Who doesn't knows about life insurance? So everyone, each one of us knows about life insurance. And why? What is the purpose of investing in life insurance? In order to hedge the risk of the life uncertainty that an individual is going to face in future. In order to protect his family, he will take up the life insurance. So the basic customer needs met by life insurance policies are protection and savings. Okay, so What are the objectives that are met by investing in life insurances? Protection and the savings. Policies that provide protection benefits. They are designed to protect the policy holder and his dependents from the financial consequences of some uncertain events such as death or long-term sickness or disability. Policies that are designed as savings contracts allow the policyholder to build up funds to meet specific investment objectives such as income in retirement or repayment of loan. Okay, that is, in practice, many policies provide a mixture of savings and protection benefits to the policyholders. Some of the common types of insurance policies are endowment plan, money back plan, whole life insurance, unit linked plan, term insurance, immediate annuity, deferred annuity, riders, etc. These are some of the categories of the life insurance schemes that have been categorized. What is endowment assurance? Actually, there are two basic types under endowment assurance. One is non-participating endowment insurance and participating endowment insurance. Non-participating endowment assurance, what is this? It offers a guaranteed amount of money, that is, whatever the sum assured during the maturity date of the policy in exchange for a single premium at the start of the policy, or a series of regular premiums throughout the term of the policy. Either you can take the policy by paying a single premium at the beginning of the policy, or you also can pay a series of regular premiums throughout the term of the policy. If the policy holder dies before the maturity of the policy, then the same sum assured will be paid on the death of the policy holder. And this policy could be structured with the sum assured paid on death, which is different from that paid at maturity. Participating endowment assurance. What is this? According to this policy, the structure of the policy is similar to that of non-participating policy, except that the initial sum assured under the policy is expected to be enhanced by payment of bonuses. Okay. That is distribution of profits made by the insurance company to the policy holder. So if I want to talk in terms of Indian context, bonuses usually take the form of additions to the initial sum assured, and they become payable in the event of occurrence of the event. Okay, that is survival up to the maturity date or earlier death. Okay, whichever is earlier. What is money back plan? Actually, this is one of the popular savings cum protection policy schemes because it provides lump sum at periodic intervals. For example, given an initial sum assured of rupees 1000 and a term of 20 years, the policy may provide for part payment of sum assured like 20% at the end of fifth year, 20% at the end of 10th year, 20% at the end of 15th year, and 20% at the end of 20th year. And it also adds some benefits by providing the guaranteed addition to the initial sum assured every year. And whole life insurance, it provides a benefit on the death of policy holder whenever that might occur. That is, basically it provides long-term financial protection to the dependents, and this is particularly useful as a means of protecting some of the expected wealth transfer that a parent would be aiming to make to his child or his grandchild whenever he or she dies. And without this policy, the wealth transfer is likely to be very small if the parent dies at a very young age. And these policies also could be tax efficient way of transferring wealth at any age depending on the legislation. Okay. And under this, there are both non-participating and participating versions. Non-participating policies offer a guaranteed sum assured uh, on death. Under participating policies, the initial guaranteed sum assured may be increased by providing bonuses or cash refunds. And unit linked plan, it is a plan and it is also an investment oriented product. Compared to other investment plans, this option functions like a mutual fund. It is invested in a portfolio of debt and equity instruments, and conformity with the announced investment policy. Then term insurance. It is a pure protection policy which provides benefit on the death of the policy holder within a specified term, say for 5 years or 10 years, 20 years or whatever. And the premiums may be paid regularly over the term of the policy or for some short period or as a single premium, and there is no payment if the policyholder survives to the end of the policy. That is, if the policyholder survives till the end of the policy, there will be no refund of the amount. So that is about term. And next is immediate annuity, and this type of policy will meet the policyholder's need for regular income. For example, after the retirement, if a policyholder wants to continue to get regular income, that is provided by this type of policy, and it can be structured to provide an income for a limited period. That is, for example, to pay the school fees of the policyholder's children, and the regular income is purchased by paying a single premium at the time of the policy, taking the policy. Then deferred annuity, the structure of this policy is that the policyholder pays regular premiums for a period up to the specified vesting date. And these premiums buys amounts of regular income payable to the policyholder from the vesting date. And a single premium at the start of the policy is a possible alternative to the regular premiums. Then about riders, they are add-ons to the life insurance policies. That is, in addition to taking the life insurance policy, you can also choose riders, and these add-ons can be purchased with the base policy on the payment of a small additional premium. Some of the commonly offered riders in Indian contexts are accidental death benefit rider, critical illness rider, waiver of premium rider, and the term riders. Then the last type is the tax breaks. That is, at the time of getting the policy, the tax breaks from a policyholder's perspective are the premium payable under life insurance policy is tax deductible from, that is, it is tax deducted from taxable income under section 80C of the income tax of 1961. In case of an individual, the insurance policy can be on the life of the individual or on the life of the spouse of the individual or on the life of any child of the individual. So the deduction under section 80C is available for premiums payable under a non-commutable deferred annuity and for contribution made by the individual to any notified pension fund set up by mutual fund or by the UTI. So next, coming to the next type of investment avenue, that is on real assets, that is physical assets. That is, an investor can also invest in physical assets like real assets. Under real assets, you can invest on a residential house, commercial property, urban and semi-urban land, agricultural farm, time sharing in a holiday resort, He can also invest in precious metals like gold and silver, precious stones like diamonds, many other types of precious stones. And he also can invest in art objects and collectibles like paintings, sculptures, antiques, and other types of objects and collectibles he can invest in. So these are some of the investment alternatives that are available for an investor to invest. So in order, instead of investing in just one type of avenue, an investor can choose investing in lot of avenues that are available to reduce his risk, and also he can choose an investment avenues based on his objectives, based on his goals, etc. There are plenty of alternatives that are available for an investor to invest in. So students, thank you for listening, and we will look up other topics in our forthcoming videos. Thank you.